Welcome to the Morning Download Podcast, your go-to resource for personal finance, economics, and market insights. In just 8 minutes a day, we provide valuable information to help you make better money decisions. Don't forget to sign up for our free newsletter at https://www.morningdownload.com/subscribe. Let's dive right in. In today's episode, we'll cover topics such as falling inflation, Target's mixed performance, investing in AI, the state of the U.S. economy, the challenges faced by retail stocks, the latest updates in the crypto market, and Warren Buffett's insight on retirement savings.
Let me share a fun fact with you today. Have you ever heard of shoe leather cost? It's an interesting concept. During times of high inflation, individuals go through increased costs and inconveniences as they try to combat the impact of inflation on their purchasing power. Picture this scenario: people making more trips to the bank to withdraw smaller amounts of money. This extra running around effectively wears out their shoes faster, hence the term shoe leather. It's a quirky way to illustrate that inflation not only diminishes the value of money, but it also introduces additional costs and behaviors into our everyday lives. Now, on to the latest updates. It seems like inflation is on the decline, which is definitely great news. In other news, Target managed to hit the target, but unfortunately missed the bullseye. And for those interested in AI, I've got some valuable tips on how to invest wisely in this rapidly growing field. Embrace the future with AI. So, here's some news about the economy. Retail sales in the U.S. took a hit in October, marking the first decline in 7 months. It seems like Americans decided to cut back on their spending, which hadn't happened since March. One possible reason for this is the high interest rates that we're currently experiencing, the highest in 22 years to be exact. Now, this might sound like bad news, but it could actually be a good thing for the Federal Reserve, or the Fed as we like to call it. See, they've been trying to curb people's spending habits, and this drop in retail sales could be an indication that their efforts are paying off. It's also a sign that inflation might go down next year, which is something the Fed has been working towards. In terms of what's been affected the most, it seems like big ticket items took the biggest hit. Car sales fell by 1% in October compared to September, and furniture sales declined by 2%. However, it's not all doom and gloom. Some areas actually saw a little boost. Restaurants and supermarkets saw a slight increase in sales, with a rise of 3% and 7% in October respectively. Now let's move on to some global news. In the UK, inflation has gone down by half this year, but economic growth is still a bit elusive. It's a tricky situation they find themselves in. And speaking of tricky situations, Google, Meta, Snap, and TikTok are facing claims related to teen addiction. This is definitely something worth keeping an eye on. Lastly, Warren Buffett's company, Berkshire Hathaway, made a big move. They sold off all their GM stock. Quite the decision, huh? So, let's talk about Target and its recent performance in the stock market. Now, Target has been dealing with a few issues like poor inventory management and some letdown in expectations. And unfortunately, this has resulted in their stock facing its largest drop since the great financial crisis. Ouch. But here's the thing. There's some good news amidst the not so great news. Target's third quarter results were actually better than expected. They managed to earn an EPS of $2, 10 beating the estimated $1, 48, and their revenue also came in higher at $25. $4 billion compared to the estimated $25, $24 billion. So that's definitely a relief for investors. But here's where it gets interesting. Despite not being all that thrilled about the future, Target stock had a fantastic day recently. It shot up over 17%, even though their sales didn't exactly reflect that kind of growth. Talk about surprising, right? Now, while it's tempting to jump on board and invest in retail stocks like Target, we would advise caution. Retailers have been facing a whole bunch of challenges in the past few months, and the overall outlook isn't really looking that great, so it might be wise to tread carefully in this area. Let's dive into the exciting world of crypto. It seems like there's never a dull moment in this space. I've got some interesting news items to share with you. First up, the New York State Department of Financial Services, NYDFS, is stepping up its game when it comes to protecting crypto investors. They've released new guidelines for listing or delisting cryptocurrencies, which is a positive move for the industry. Now let's talk about the U.S. Securities and Exchange Commission, SEC. They're apparently taking their time in making decisions. They've delayed a ruling on Hashdex's application to convert their Bitcoin Futures Exchange Traded Fund, ETF, into a spot vehicle. And that's not all. They've also pushed back their decision on Grayscale's new futures-based Ether ETF. The SEC seems to be keeping everyone on their toes. On a more positive note, Solana, a popular blockchain network, is making some waves. It recently hit new yearly highs, gaining a remarkable 17% in just one day. This surge in value came after Cathie Wood, the CEO of ARK Invest, praised Solana for its efficiency and cost-effectiveness. Looks like Solana is definitely on the right track. Lastly, despite the recent market crash, crypto still managed to be the best-performing asset of 2023. Some digital coins saw gains of over 300% this year so far. That's pretty impressive, right? AI is the future, and luckily it's not too late to jump on the bandwagon and reap the benefits. There are several ways to invest in this growing trend, but it's important to note that not all AI companies are positioned for success, and not all of them are publicly traded. Here's how you can get a share of the pie. One option is to invest in AI stocks. Buying individual AI stocks can be highly profitable, assuming the company succeeds. Microsoft is a leading player in the field, with CEO Satya Nadella showing great enthusiasm for AI. They have even partnered with OpenAI to integrate ChatGPT with Bing search engine. Microsoft stock has performed well recently, gaining about 30% since the beginning of the year, and analysts have a median target price of $400. Another notable player is NVIDIA, a semiconductor company that has seen a whopping 241% increase in stock price this year. Although it faced some challenges due to China-US tensions, analysts remain bullish on NVIDIA, with an average price target of $645.53. If you prefer to reduce risk, you can invest in AI ETFs, exchange-traded funds. These funds often focus on a portfolio of AI-related companies and provide exposure to the AI market while diversifying risk. Some popular AI ETFs in the US include Direxion Robotics, Artificial Intelligence and AMP, Automation, Global X Robotics and AMP, Artificial Intelligence, and Franklin Intelligent Machines. These ETFs have shown impressive returns ranging from 43% to 73% over the past year, outperforming the S&P 500 index, which only had a one-year return of 70%. Finally, don't overlook lesser-known names when considering AI investments. Some promising options include Relex plc, Arista Networks Inc., and SAP SE. These companies may offer potential opportunities that larger, more popular names overlook. Investing in AI can be a smart move for those looking to capitalize on the growth and potential of this industry. Whether you choose individual AI stocks or AI ETFs, it's important to do thorough research and diversify your investments to maximize your chances of success. So here's today's personal finance quote for you. Warren Buffett tells us how important it is to pay attention to fees when it comes to our investments. He points out that if your returns are expected to be around 7 or 8%, but you're paying a 1% fee, that fee can have a big impact on the amount of money you'll have during retirement. Think about it. That seemingly small percentage might not seem like a huge deal at first, but over time it really adds up, and not in a good way. That 1% fee can eat away at your returns, potentially leaving you with a lot less money in retirement than you anticipated. So, what can you do to minimize the impact of fees? Well, one option is to look for investments with lower fees. It's important to do your research and compare different investment options so you can find ones that offer competitive returns without hefty fees attached. Remember, every dollar you pay in fees is a dollar that could have been working for you and growing your retirement savings. So, take a closer look at those fees and make sure you're not sacrificing a significant chunk of your future financial security.
From falling inflation to Target's mixed results, investing in AI and the latest in the crypto market, this episode has covered a range of topics for investors looking ahead to an exciting 2024. Additionally, we explored the potential implications of U.S. retail sales decline and Warren Buffett's advice on fees' impact on retirement savings. Thanks for tuning into the Morning Download, your go-to podcast for personal finance, economics, and market insights in just 8 minutes a day. Don't forget to subscribe for more helpful content and sign up for our free newsletter at morningdownload.com/subscribe.